Hello and welcome to Trading Hour. I'm Sonia Shenoy and with me is Pavitra Parekh and Sumaira Abidi. Well, the market, amidst all the global volatility, the market is trending higher. Things are looking decent this morning. Of course, there is some choppiness that you can see the jagged edges on your screen. But give and take everything, this is not a bad showing. The drag in the market today is coming from the banking space. So there's plenty of profit taking, if you want to call it that. ICICI Bank, Axis Bank are all seeing their profits being taken off. SBI is under pressure as well. So that stands out as a sore thumb of the market. The mid caps as well are tentative, down about 75 odd points. But other than that, the Nifty is holding up with gains of about 60 odd points. Let's see, the day is long and for now we have begun with some amount of volatility. Hi guys.
Hi, good morning. Some amount of volatility after that very quiet open, right? So there are some stocks which are really moving around under the surface. So if you take a look at few of the auto names are moving quite well. You have Maruti's earnings today, so a few of the auto names are in focus. Reliance, by the way, is a big mover today. It's up over 2%. And a lot of the PSU stocks, so the likes of Coal India, ONGC, all of these also doing well. It is the metal stocks also which are seeing some cuts today in addition to the banks which Sonia mentioned. So this is of course after the sharp run-up that we had yesterday. So maybe just some par for the course. And remember, overnight in the US, we have been getting all of those earnings from the tech companies, and those have looked extremely weak. So this is what happened in the US overnight. And in spite of that, IT over here is holding up quite well. So that's, good news. It is a heavy day for us in terms of earnings as well. So Maruti, Dr. Reddy's, Bandhan Bank, Tata Power, you have all of those. So Sumaira, it could be a lot about these individual names also, in addition to, what's happening at the market level.
All right, good morning, ladies, to both of you. So let's get started. And as usual, we have a packed day ahead of us. So here's all that you can expect over the next 60 minutes. It's a steady start to the market amidst mixed global cues. So we'll talk about the way forward with Varun Goyal of Nippon India AIF in just a few moments.
From the earnings corner, we will be joined by the management of Latent View Analytics to discuss the company's second quarter performance.
Stocks like SBI Card and Tata Chemicals slip following their quarterly numbers. We'll talk about the important takeaways in a bit from now.
And Nykaa continues to slump as the one-year lock-in for pre-IPO investors ends early next month. Details coming up for you in just a bit.
And in Q2 numbers to track, we'll get you the expectations from Dr. Reddy's and Maruti, the two big ones, later on the show. All of this and much more lined up over the next 1 hour.
All right, so it's an action-packed 1 hour. Let's invite our first guest on the show now. We have Varun Goyal of Nippon India AIF, who joins in to discuss the markets, his top sectoral bets, and the way forward. Varun, welcome to the show and thanks for being with us. I have to start by asking you about a lot of these platform companies that are under intense pressure right now, not just Nykaa, which of course has a resignation of its CTO as well, but other names, whether it's Delivery, Paytm, PB Fintech, all sitting at fresh lows this morning. What do you do here? There is the pre-IPO lock-in that ends on the 10th of November as well. Do you exit these names if you hold them, or do you look for some opportunities here?
Good morning, Sonia. Thanks for having me on the show. I think the profitless tech theme is something which got significantly overrated across the world. And I think what we are seeing as the cost of money is becoming higher, as the capital is becoming tighter. A lot of these names are getting derated. We thankfully stayed away from this throughout last year and this year too. And we hope that valuations will soon come to an area where markets will value them based on profits and not just on future growth potential. So there is no doubt that there is a lot of growth in digital companies. The next 5, 10, 15 years, we will see a lot of these companies getting bigger. But one has to focus on profitability, ROEs, and respect for shareholder capital. And once we see value emerging there, we would definitely look at investing in these names. So far, we have stayed away.
All right, so far you've stayed away from these platform companies. Varun, good morning. Thanks for joining us. This is Pavitra. What about the old school tech companies? I mean, of course, they have corrected significantly from the top, but valuations have corrected and it could, prove to be a good entry point. Do you think that it's a good idea to take some positions in the IT names, or do you think that there is more of a fall coming?
Good morning, Pavitra. I think the traditional Indian IT companies should see a strong earnings growth in the next 2 to 3 years. Valuations have corrected by 30, 40, 50% depending on the name. I think as far as the whole shift to cloud and the digital, be it US manufacturing, telecom, financial services, that trend continues across the world. Europe, of course, is seeing some cross-currency headwinds, but overall we see a 10 to 15% top-line growth outlook. The biggest problem for Indian tech was more on the margins, which was led by attrition. Thanks to the slowdown in the growth environment, we are seeing some of that problems also getting resolved. Combined with almost a 10-12% depreciation in rupee, I think even the margin headwinds should get addressed. So we believe for most large cap companies and select mid cap companies, the valuations are much more palatable now. And if one were to take a 2 to 3 year view, this sector is definitely worth investing with a 10 to 15% top line, bottom line growth, and 15 to 20% kind of 1 year forward PE. So this remains one of the top sectoral choice for us.
Hi, Varun. Morning. Since the focus is on bottom-up stock picking, from the earnings universe, which have been the big hits or misses from the set of stocks that you all track?
I think the biggest, the positive surprise in this earnings has been the banking sector, especially the mid-cap banking space. I think for the first time since 2013, we are seeing a double-digit credit growth, which seems to be sustaining. For the most mid-tier private banks, NBFCs, we have seen very strong commentary. They are talking about 15 to 20% credit growth, and that is why you see most, mid-tier public sector banks and the private sector banks and NBFCs getting significantly re-rated. Most of them have done quite well in the last few months. Our sense is, even if the credit growth were to slow down slightly from the 15-16% that we have now to 13-14%, most of these names, the large cap ones and the mid cap ones, should continue to see very, very strong earnings growth. The top line growth, of course, is there. The asset quality of the banking system as a whole is quite good. We don't see a significant acceleration in NPA cycle just yet. So we might have a 2 to 3 year strong period for large cap banks, and of course for the select mid-cap private banks and NBFCs. So that has been the star performer of this earnings season for us.
Okay, the star performer undoubtedly, right? The other space that you like, Varun, is the real estate sector. But if you map the trajectory this year, right, of most of these big real estate guys, they've not done much. I mean, Oberoi Realty, for example, is up about 3% this year. DLF is down 2%. Prestige is down about 6%. So while they're selling a record number of homes, the stocks have not done much. Your views here?
So I think the biggest thing which makes us positive on the residential real estate space is that one, post-FERA, most of these companies have seen significant improvement in corporate governance. In fact, the first time, in 15, 16 years, we have started taking a very bullish view on real estate in the last 1.5 years. Second is, I think if you look at affordability, in 2013, your EMI to take home salary ratio, which is, if your salary was 1 lakh rupees, you were paying 50,000 for EMIs. Today, that number has come down to 35,000. So your loan to EMI to take home salary ratio is down to 35%, despite the increase in interest rates. So affordability has gone up, salaries have gone up. We have seen 8-9 years of poor real estate cycle. So now we think things will definitely catch up. Now, before demon, interest rates were where they are today. Mortgage rates were at 8.5-9% before demonetization, and we are back at that level. So our sense is the end user demand will be there. We will see a 5 to 10% increase in prices. We are seeing a very, very strong volume growth. So while, yes, this year residential real estate stocks have been underperformer, that is primarily on the back of very, very strong performance the year before. Our sense is, if we were to take a 2 to 3 year view, we should see significant growth both in pricing and volume, and we remain quite bullish on the sector as a whole.
All right, quite bullish on real estate. The other space that I can see you like is the auto space. A lot of these stocks have already rallied quite a bit, right? So do you think that they still are, good to get into at these levels as well? And then within the auto space, what do you like? Do you look at the two-wheelers, the, passenger vehicles? Would you play the EV theme? How do you approach the sector?
So we would avoid the two-wheeler space. I think that's where we will see the largest disruption. We like the tractor space and the CV space. I think that's where the largest value will get created. We are seeing already early signs of the tractor cycle turning into positive. We have seen a good festive season. The passenger car space, especially those companies which are geared towards the EV space, should see good earnings growth. We also like some of the select auto ancillary plays, which are more immune from disruption from the EV side. So that's the space that we would focus on.
Okay, so that's on the EV side. Of course, some of these players like M&M have done exceptionally well. So what do you do with names like this, Varun? Because, you know, on one hand, of course, growth is there. But on the other hand, these stocks have rallied so much. You think it's too late to enter now for some of these names like M&M?
Well, I think if you look at the auto sector as a whole, 2019 was the year when the space peaked out in terms of volumes. We are seeing a gradual recovery. So our sense is the recovery will be more gradual, especially in light of what we are seeing in the rural India, where recovery is more muted, while urban India has bounced back very, very strongly from the post-COVID situation. That is why we like passenger vehicles more as compared to some of the two-wheeler focused stories. Having said that, we hope that in the next 6 months, even the rural India will catch up. So we will remain selective. I think a big re-rating for the auto space is already done. From here onwards, it will be more bottom-up stock picking wherever earnings growth sustains, and tractor stories and select passenger vehicle stories and CV stories. That is where we would be focusing on.
All right, we got that. Varun, thanks a lot for joining us and taking us through your call on the market. You like the banks, you like real estate, you like even some IT names as well as the auto pack. But for that, we're going to get into a short break now. When we come back, we're going to shift focus to the world of commodities and tell you what's going on there. Manisha Gupta will join us.
Hi, welcome back to Trading Hour. The focus now shifts to the commodity space. Manisha joins in, and today the focus is on cotton. Hi, Manisha.
Thank you for that, Sumaira. Well, I'm looking at cotton prices, pardon me, because we have seen constant decline into this space. International cotton prices are now trading at a 22-month lows. In this week, we've seen the prices decline by 5%, and for the month of October, we're down by nearly 13%. If you look at the 2022 price trends, the high of this year has been $158 per pound, and the low has been 74. That's exactly where the markets are trading right now in the international space. There also is a report from USDA which says that for 2022-23, they're looking at consumption declining to 115 million bales, which is 3 million bales less than last year. And when you look at production, that is looking at an increase of nearly 2% at 118.1 million bales. So we are looking at excess supplies in the international markets and consumption not so much. When you talk about the Indian markets, then here as well, we did see high sowing, higher crop, lower exports into the markets, and this is a peak arrival season as well. So that is the reason cotton prices are under pressure. The Cotton Corporation of India also is looking at a higher crop this time around at around 361 million bales. Last year was 31.5 million bales. So we are looking at that number increasing as well. If you look at the Indian prices as well, we saw an all-time high of around 10 lakh rupees per candy, but the prices have declined now to around 70,000, with the market anticipating that as we see peak arrivals coming forward, the prices could decline to below 60,000 rupees as well. That could be positive as a raw material for the ginning and the textile as an industry. But at this point in time, it still is prices falling into the market, Indian and international.
All right, Manisha, thanks a lot for getting us all of those updates on the cotton prices. But with that, we have to get into a break. As we do that, here are some market opinion. This comes in from Ishwar Prasad, who's professor at Cornell University, as well as the former head of IMF's China division. So listen to what he has to say on the outlook for emerging markets, as well as the big India opportunity.
It's clear that there is an opportunity here for India in terms of becoming an important part of global supply chains, and in terms of becoming a supplier of certain products where China has tended to dominate the market so far. And I've been quite encouraged, to tell you the truth, to see that unlike in previous episodes where the rupee depreciated, but we didn't see much of an effect in terms of India's export growth, we are seeing Indian exports doing somewhat better than they used to in the past episodes of rupee depreciation. And more importantly, we are seeing some high technology exports beginning to pick up. So they're not at a level yet where they would make a huge impact on India's growth. But I think this can be the foundation for India becoming a much more important part of global supply chains and moving up the value-added chain, moving into higher technology sectors itself. My view about China has always been that there is a lot of room with monetary and fiscal policies to stimulate growth in the short run, because you can use monetary expansion, either cutting interest rates, flooding the system with liquidity, or use government expenditures. In some areas, China certainly needs more expenditures in order to stimulate short-term growth. But right now, I think the economy is faltering because there is a combination of the drag caused by the determination to stick with the zero COVID policy, a faltering property market, which is really important for the Chinese economy because it accounts for a significant share of GDP as well as household wealth. And on top of that, financial system stresses that are beginning to bubble over. On top of that, you have a very unfavorable external environment, and that is also making it harder for China to use, for instance, monetary policy very effectively, because the Chinese renminbi or yuan has been depreciating very significantly relative to the US dollar.
Indiabulls Housing Finance Limited announces a public issue of secured redeemable NCDs, offering coupon rate of up to 9.55% per annum and additional incentive of 0.25% per annum. Tranche 3 issue closes on Friday, 28th October. To subscribe, log on to Indiabulls Home Loans.
Hey guys, welcome back. You're still tuned into Trading Hour, and let's start talking with our management now. We have Latent View Analytics on our radar. The company delivered strong revenue growth for the second quarter. The margin performance was also quite steady this time around. In fact, if you take a look at the past 3 quarters, they've managed to sustain revenue growth at over 35%. This is ever since their listing, so that figure is up on your screen. So let's get chatting with the Chief Executive Officer of Latent View Analytics, Rajan Sethuraman, joins us now. Mr. Sethuraman, good morning and thanks a lot for joining us. This is Pavitra. My first question to you is on the revenue itself. You've done 40% this quarter. Do you think this level is sustainable? Do you expect higher than this? What should we expect going forward?
Good morning, Pavitra, and thank you for having me on the show. Yeah, we had a very strong quarter, and as we have been giving guidance before, we expect to exceed the industry performance by a significant margin, as has been demonstrated in the last 3 quarters. So while people are talking about macroeconomic headwinds at this time, we have continued to see robust demand for our services, and that's reflected in our performance. At this point in time, I wouldn't be able to give guidance, but we don't see any headwinds which are of significant consequence at this time. So I'm expecting that we'll be able to maintain this trajectory in the next few quarters.
Okay, that's a very optimistic statement. You're saying you continue to grow higher than the industry and things are looking better from here. The last time when we spoke to you in August, Rajan, you did mention that the deal sizes are getting bigger. So from an average of around $0.4 to $0.5 million, your deal sizes have gone to $1 to $2 million. Since then, since August, how has the trajectory been and what is the visibility in terms of deals?
Yeah, so this quarter, we actually added 5 new accounts to our portfolio. And interestingly enough, we had the first $2 million plus single contract, right, in annual revenue this quarter. This is the first time that we have done this. So while we have large accounts where cumulatively across multiple contracts, we are far in excess of $10 million, this is the first instance where we had one SOW, statement of work, which exceeded $2 million in annual revenue. So I think the trajectory is along the lines that I indicated earlier. So even with the remaining 4 accounts, we have seen a positive trend in terms of increasing deal sizes. The one thing though is that larger deals will typically involve a larger ecosystem of constituents and participants from the client side. So some of the times the deals take a little longer than anticipated, but we are not worried by it because the effort is rewarded with larger deals right at the end of that effort.
So just to follow up here, since you're saying that you signed your first large $2 million contract and deal sizes in general have gone up, you had earlier hinted for a FY23 revenue target of around 500 crores. It was not a hard guidance, but do you think you can do better than that, given that the size of the deals have gone up?
Yeah, so I think at this point in time, our run rate is already better than that number. So I wouldn't be. I would hope that we'll be able to maintain that trajectory, and we should be able to exceed that number. I'm not going to put out a guidance in terms of how much we will exceed that by, because of course all of us are aware of some of the uncertainties in the macroeconomic scenario. But as I said earlier, going by conversations and deals in the pipeline at this time, I'm not worried about getting past that number at this time.
Hi, Mr. Sethuraman. Morning. Your margins had declined in Q1 because of the wage hike impact. In Q2 as well, they're closer to those levels. When do we expect them to bounce back to those 34-35%?
So as we have mentioned in the past, our margin range that we are comfortable with is in the 25 to 28% range. So while we had those supernormal margins during the COVID period, you would understand that much of it is also on account of reduced travel and marketing spends at that time. And that is not a level at which we want to sustain. More importantly, given the market opportunity, right, and the growth that is possible, even if we were able to generate margins higher than 28%, we would want to take it and plow it back into the business to drive growth. So that is our primary objective at this point in time. So the guidance will continue to remain in the 25-28% range at this time.
Okay, Mr. Sethuraman, you'd also mentioned that you want to keep aside, around 150 crores for acquisitions, and you are looking at, finding something attractive. Have you come across anything yet? And is there any kind of inorganic growth on the cards?
So actually, over this quarter, we went as far as a letter of intent and due diligence on a couple of opportunities, which means that we actually spent considerable management time and effort in evaluating those opportunities, but unfortunately, they didn't pan out for a variety of reasons. We are just being extra careful at this time, given that this is the first acquisition, and we want to make sure that it is accretive, right, to the company that we are acquiring, as well as all investors and shareholders from a revenue and margin perspective. So cultural fit and the ability to sustain the growth momentum is very important for us. So we have since then engaged 2 external partners to help scout for opportunities, and we already have another 10 on the table at this time, right, that we are evaluating. I don't want to put a timeline to when we will close our first deal, but we are hoping that we'll be able to see some significant traction in the rest of the fiscal and get close to closure when the end of the fiscal comes around.
That figure is still correct, that you're looking at around 150 crores? Is that what you've earmarked for acquisitions?
No, actually, it's a much larger number. If you take a look at the money that is available from the IPO plus our own cash reserves, we are almost sitting on about 1,000 crores, right, of capital. So while obviously we won't look to use all of it from an inorganic standpoint, the kitty that is available is much larger. And that is good news because we can actually look at substantial opportunities, right, which can actually help us hit the ground running from a revenue as well as margin perspective. So that is the intention, meaning that can we achieve a step change while maintaining the growth and the margin trajectory. So that is the main criteria. We want stickiness. We want, especially we are keen on opportunities that will help us focus on our specific areas, Europe as a geography, PFSI and retail as industry segments, and data engineering and supply chain analytics, right, as horizontal. So these are the ones that we are focused on. And we do have good opportunities on the table at this time.
Okay, this is important. So your acquisition could be much larger than 150 crores, you're saying, and you're sitting on about 1,000 crores of cash. Have you factored this into your 500 crore plus revenue target for this year? You said you'll far exceed that, but you don't want to tell us by how much. But do you think some amount of these acquisitions could get factored into this fiscal, or it's too early? You're looking at
this fiscal might be too early, because even if we were able to identify and move towards closure, by the time we do the closure, I don't think we'll be able to consolidate much of the revenue in this fiscal itself. So the intent right now is to plow a lot of investments into the right channels from an organic growth perspective. So the 500 crore plus number that you mentioned and going past that will also be driven by the investments that we have already started making, right, in all those focus areas that I mentioned. And that is expected to pan out for this year.
Okay, so what is the organic plus inorganic compounded growth target that you have, say, for the next couple of years? What could an average growth look like for Latent View?
So organically, we had indicated that industry plus kind of a growth rate. So last year we did 33%. This year we are on target for a 25 to 30% kind of a range. We believe that we can sustain that organic growth trajectory. Now, as I mentioned earlier, the inorganic acquisitions will help create a step change so that we are able to add substantial numbers, right, to the top line and bottom line, but maintain the trajectory from a growth perspective from there on. So the inorganic should give a clear lift, right, if you were to do that and integrate and synergize well. So that is the plan. So there will be that 25 to 30% growth trajectory, but hopefully there'll be a step change on that as well, right, as we go forward with the acquisition.
Okay, we leave it at that. The street likes what they're hearing. The stock is up about 4%. Rajan, thanks a lot for being with us on CNBC TV18. That's Latent View. They're saying that demand is very robust. They continue to grow higher than the industry. They're targeting 25 to 30% organic growth in just this fiscal, sitting on over 1,000 crores of cash and looking for some inorganic moves as well, some acquisitions that they plan to close very soon. Let's slip into a quick break on that note. Lots more coming up on the other side, so don't go anywhere. Well, for now, there are lots of stocks on our radar. And by the way, Latent View is gaining more ground after the company said that they will be able to exceed that 500 crore revenue target by FY23. So that stock is now up in excess of 4%. But let's get you some more stocks on board. Nykaa is at a new low today. The one-year lock-in for the pre-IPO investors ends early next month. So there could be supply kicking in. And there is the resignation moving out of the CTO as well. Mangalam is here to put all of this into perspective for us. Mangalam, over to you.
There are a bunch of reasons why Nykaa is under pressure in today's trading session. And why just today's trading session? In fact, from its post-listing high, the stock has actually corrected over 60-odd%. And it's, fallen below the IPO price of 1125 as well. And now it's lower by almost 12 to 13% as against its IPO price of 1125. Now, there are three reasons. The first one, like you pointed out, early next month, November 8th, 9th, we have the lock-in for those who were allotted shares pre-IPO, which ends. So, as per their red herring prospectus, almost 47 crore shares or 98.5% of the company's equity was allotted pre-IPO. Now, of that, 52.37% is promoters holding. Part of promoters holding also gets freed up, but assuming that promoters aren't rushing to the exit door, that still leaves about 46% of the company's equity or nearly 21.8 crore shares, which are eligible to be sold. So the street is worried about the kind of supply coming in post this lock-in ends on November 8th and 9th. The second part is the replacement of the CTO. We understand that Rajesh Uppalapati has been appointed as CTO in place of Sanjay Suri. Now, Sanjay Suri has been an old hand, was with the company since 2016 itself. So it'll be interesting to see what has happened out here, because Rajesh Uppalapati, as far as his credentials are concerned, has been with Amazon for almost 2 decades. So no problems with the credentials. The reasons are important, and we've seen a few other senior level exits as well. The third most important reason, that the company reports its results next week, the second quarter results. And if deliveries update is something to go by, we've seen that, the second quarter is no different from the first quarter. So maybe the street wants to give it some time before they look at the third quarter and then take a fresh look at the stock.
All right, Mangalam, thanks a lot for getting us all of those details. The stock is off the lows, but it is still seeing cuts of over 4%. With that, let's move on and talk about some key results that came through as well. SBI Card slips after a disappointing set of Q2 earnings. So Abhishek is here to really break down all of the numbers for us. Abhishek.
Well, Pavitra, to begin with, the revolver rate or loans which become overdue past your due date, that has declined from 45% in Q1 FY21 to about 24% in Q2 FY23. So what this means is that the earning capacity of SBI card is actually reducing. So we can see that in the yield as well, which is down from 22.8% in Q1 FY21 to now about 15.1%. And even the net interest margin has contracted from 19.2% in Q1 FY21 to now about 12.3%. Credit cost has remained elevated for last many quarters. It is at 5.6% versus 5% in the previous quarter. Asset quality, an improvement of 10 basis points is seen in the gross NPA ratio, which has now come down to 2.14%. Total income was up 28% YOY and about 6% sequentially. However, the PAT has come in at 526 crores versus Motilal Oswal Securities estimate of about 590 crores. So brokerages have cut EPS anywhere between 1% to 17% for FY23 and between 2% to 14% for FY24. So higher than expected credit cost is a negative surprise, and the decline in revolver book is actually another negative surprise that they see. So JP Morgan has downgraded the stock to neutral, cut the target price by as much as 24%. So now the brokerages range of target price ranges from as low as 700 per share to as high as 1175 per share. Back to you.
Okay, thanks a lot for that. So that's an SBI card, but Tata Chemicals also on our radar. The company, despite reporting a 40% growth in revenues, the stock is down. That's because the margins misread expectations. It's a 4% knockdown on the stock. Sonal gets us the earnings fine print. Sonal, over to you.
Thank you for that. Well, yes, it was a margin miss, but what the street is not liking this time around. Revenues were up 40% on a YY basis, but EBITDA margins, they were lower than what the street was working with. EBITDA grew around 84%. Margins also grew 400 basis points versus an expectation of 800 basis points expansion. Profits were higher, aided by other income, which was higher, and expenditure, which was lower this time around. Now, in the basic chemicals business, the revenue growth was strong at 45%. EBIT margins also expanded on a YY basis, but they declined on a quarter-on-quarter basis. That could be because on a quarter-on-quarter basis, soda ash prices would have come down. In the specialty chemicals business, it was an increase both on a YY and on a quarter-on-quarter basis in their EBIT margins with a revenue growth of 27%. Company says that they saw higher realizations in their overseas units due to improved realizations on a YY basis. Gas, coal and freight costs, they're still higher, but they're stabilizing. So that is definitely a positive. Soda ash prices continue to remain robust across geographies. So despite this positive commentary, the stock has come in for some profit taking as well because it has seen a stellar run this year. We have the conference call in next 20 minutes. So we'll be watching out for more details here.
Sonal, thanks very much for that. Also, Sun Pharma's US arm Taro has reported a weak set of second quarter numbers. Ekta has all the details on that one. Hi, Ekta.
Thanks for that. Well, yes, definitely a disappointment which has come in for Taro because they have reported what is a revenue which is absolutely flat on a year-on-year basis. And to put it into perspective, the street was anticipating around $160 million in terms of sales. So they've reported around $130.5 million. Now, what has been more disappointing is the operating loss. So they have reported an operating loss of around $6.81 million. If you adjust it as well, the margins have been just about 0%. So they've just about reported a flat performance, which is weak versus the single-digit margin reported last quarter, as well as the 24.4 million operating profit, which was reported same time last year. Also, this resulted in a loss of around $2.8 million, which they have reported this quarter. The company has said that the overall numbers were impacted because of the price decline in the US generic business that they are facing. They are facing headwinds in terms of price erosion. And remember that they did make an acquisition recently. So despite the integration of the acquisition, the sales didn't rev up. So that is something which has concerned the street. And that acquisition integration also impacted the margins. Now, based on some reports that I've been reading, in fact, it is the fourth or the fifth quarter that Taro has missed EPS estimates in the US. Remember, it is a US listed company. And separately, just want to point out that Sun Pharma does report its numbers on the 1st of November, while the street is anticipating a good set of numbers because of the generic business, because of the specialty business. The margin estimates could probably be scaled off because of Taro's performance.
Okay, thanks a lot, Ekta, for that. Just want to mention that some big moves coming in the healthcare space. Narayana Health is now up almost 8%. It's been a decent mover this year. Narayana Health has gained 25% this year and now at almost at 800 rupee mark. So good moves coming in there. Let's slip into a quick break on that note. On the other side, some important opinion, or rather we'll get you important opinion right now from Ed Yardeni, the president at Yardeni Research, on what to expect from the big US Fed meeting next week and how to approach emerging markets. Take a look.
I don't know that the Fed is going to change its mind based on the GDP numbers, but we also had some numbers that suggest that up ahead here, looking into the fourth quarter, we're going to see somewhat slower growth, but also see somewhat lower inflation. Inflation is really what this is all about. And I think the Federal Reserve is committed to 75 basis points at the November meeting. I think they're going to go for 75 basis points at the December meeting, but soften that up by indicating that they are going to pause in the first half of the year. And I think that's what the market is getting excited about, is that we're getting closer to the end of the tightening phase. We're at least getting closer to a pause, let's put it that way. I think when I look around the world, I think when investors look around the world, they just see a tremendous amount of risk with what's going on in Europe, with the war, with what is going on with China becoming more autocratic and less friendly to businesses. So when global investors are looking for safe havens around the world, clearly the U.S. has been one of them, and we've seen that in the strong dollar. But another one in emerging markets has been India, and we've seen that in the India stock market.
Hi, welcome back. You're watching Trading Hour. Let's invite Mitesh Thakkar of earningwaves.com now for a quick tech check on the market. Hi, Mitesh. Morning. Let's start off with the strategy on the index now, and what are the stocks you're looking at?
Yeah. Morning, Sumira. We haven't been buying the index since yesterday. We kind of booked out around 17,800 levels. I think this 17,800 to 850 for me is a very important pivot, and it might take some effort to get past these levels. So I think the next trade will come either once we break 17,850 on the upside, or we get some kind of a pullback and a decline in this consolidation, which is closer to about 17,650. So that's the kind of view on the index. But on the stock side, trading with clearly long bias, and I have two names on the buy list right now. Petronet, I think, while the market is consolidating, these side counters are doing well, and Petronet is something which is broken out. That's a buy with a stop at 205 for targets of 215. Similarly, Power Grid is another one on the radar. That's a buy with a stop just below levels of 222 for targets of 235.
All right, Mitesh.
Okay, Mitesh, thanks a lot for that. So that's earning waves with their view. By the way, Reliance is coming back today, so 2,500 on Reliance. So just keep an eye out on that. And lots of other buzzing stocks. Let's get you some important earnings expectations. It's a big day of earnings, actually. You have lots of numbers coming out, the likes of Dr. Reddy's, Maruti, Tata Power, etc. Let me first start with pharmaceutical major Dr. Reddy's. Ekta is here to tell us what to expect. Ekta.
Thanks for that. Well, for Dr. Reddy's this quarter, we are expecting a revenue which is expected to be flat on a year-on-year basis and probably an uptick on a Q-on-Q basis. Now, just to put it into perspective, same time last quarter, there was some amount of one-offs such as licensing income, etc., which really benefited the Q1 FY22 numbers plus Q2 FY22 numbers, plus there was a COVID-19 base as well. Now, what we could expect, however, is that maybe on a Q-on-Q basis, there could be a pickup in the North American base business. Now, why exactly are we expecting a pickup in the North American base business is because there could be benefits from the likes of Revlimid generic, which they launched in the month of September, in two strengths which they have exclusivity on. So that would probably benefit Dr. Reddy's solely as compared to the other companies that are selling that particular cancer drug in the US. Also, there was some amount of price erosion in a couple of drugs that they sold last quarter. So that that kind of trend into this quarter will be watched quite closely. Now, margins are expected to contract on a year-on-year basis and as well as possibly on a Q-on-Q basis as well. One of the key variables to watch this quarter would be Russia CIS, the volatility that we've probably seen on account of sales. Remember that Russia is one of the largest exporters to, Dr. Reddy's is one of the largest exporters to Russia from India when it comes to drugs, and hence it would be an important market to track. India expected to see some amount of growth on a Q-on-Q basis. 7 to 8% is what the street is anticipating. India has been a strong market for Dr. Reddy's. It is expected to be supported in this quarter as well. Year on year, there could be some amount of a COVID-19 base which could come into play as well.
All right, Ekta, thanks a lot for lining up all of the estimates from Dr. Reddy's. But the other big one to watch today will be Maruti. So, Sonia, how's it looking? Good quarter?
Yes, it's expected to be quite a good quarter. One, because there's a low base of last year, and two, because the demand has definitely improved. There's high amount of inventory stocking that has happened at the dealer's end. Hence, the wholesale numbers have been very strong. Now, the revenue growth is expected to be 44% year-on-year at 29,590 crores. The EBITDA is expected to go up almost 220% year-on-year. As I said, it was a low base same time last year. Margins expected to improve to 9.3% versus 4.2% same time last year. And the profits will look exceptionally good. Now, this was a good quarter. Volumes have risen both year-on-year and quarter-on-quarter for Maruti. It's a 10.5% quarter-on-quarter growth and a 36% year-on-year growth. The supply chain constraints have eased. You also have low channel inventory that aided wholesales, and the margins will also go up purely because of the price hikes that the company undertook, the operating leverage as well as forex benefits. Remember, there is a benefit of yen depreciation against the rupee that results in a lower cost of raw material imports for them. 7% of the direct and indirect imports are yen denominated, hence the yen depreciation will definitely help them. The average selling price has also gone up about 1% because of the price hikes, and the success of the upcoming product launches is something that will be tracked very closely. But all in all, a good set of numbers is what the street is expecting.
All right, so we look out for Maruti today. Also, Bandhan Bank will be reporting earnings. Abhishek is standing by with the key expectations on that one. Abhishek.
Well, Sumaira, they have already given the business update wherein they are losing sheen on the retail deposits. So to begin with, the book has remained flat for H1 FY23 when compared to FY22 numbers. There is no significant improvement in collections. September collections was 97%, which compares to 96% that they had in June. Massive decline in CASA ratio by about 240 basis point quarter-on-quarter. Deposits are up 21.3% YY and about 6.8% sequentially. And there is also a decline in retail deposit share down to 74.1% when compared to 79.3% in the previous quarter. So much of the deposits or the liquidity that they have got in the balance sheet might have come from bulk or term deposits. So the key thing to watch will be the fact that net interest margin can decline YOY and quarter-on-quarter. Now, slippages and write-offs may remain elevated in Q2 FY23, which means that the asset quality may deteriorate on a sequential basis. Outlook from the management with respect to recovery from NPAs and loan growth going ahead will be seen closely. Our polls suggest NII growth of 25.2% YOY, while it may decline by 3.6% quarter-on-quarter. We are working with a profit which may decline by 75% YOY and about 15.5% on a sequential basis. Back to you.
Okay, thanks a lot for that. So that is on Bandhan Bank and the big earnings that are expected today. Let's slip into a quick break. Here's some great news for investors. You can now track the US market action real time on Money Control. Just log on to the Money Control website or the app. Stay informed about all that matters in global markets.
Welcome back. You're still tuned into Trading Hour. The market is holding up with a gain of around 45 points, but it is the banking space where you're seeing a lot of the pain come through today, so that index in itself is down over 250 points. But let's bring you some interesting market opinion. Earlier today, we caught up with Prashant Khemka, founder at White Oak Capital Management, to understand the way forward for the market, and he feels that the impact of inflation is actually much higher in other countries than in India. So listen in.
Market is obviously there's confluence of factors that are affecting the market. Global factors have been very dominating this year, particularly due to the sustained higher level of inflation, which has caused, on one side, central bankers to hike rates around the world, and B, also caused some slowdown in consumption and worries about slowdown in corporate profits going forward. So as a combination, if you see, the markets in India have been flattish because the issues have not impacted, this time around, issues have not impacted India as acutely. Because inflation in India at about 7-8%, it's not outside the range of what we are used to. The government sector PSU banks have done quite a lot better, and maybe even over the last couple of years, they've done quite well. It is, in our view, impossible to keep switching between such large segments of the market, say private sector versus public sector and so on. So the over longer time period, if you see 10, 20-year time periods, private sector has continued to gain market share. They've had much better performance in terms of credit quality as well as asset growth. So growth as well as profitability has been far superior. And these are long-dated business models. The pendulum can swing farther away from the center on either side. Now, and we won't know how far, whether we are even, which side of the center we are. We won't even know. Only in hindsight we would know. So last year, I think pendulum swung with the benefit of hindsight on one extreme, and it could be that we are at the other side of the center already, but very hard to say. There are some obviously technical factors as well right now at play with all the lock-ins that are expiring. So anyone who wants to buy would not be keen to step in and buy today and would rather wait for the lock-ins to expire.
Okay, with that, we'll take your leave. Thank you very much for watching.
Co-powered by TCI Express.